right, welcome back, and let's get right back to the Money Show, the show dedicated to your personal finances and how you can invest your money and even spend it in the right way. We did have L&T's numbers, and hence we got a bit delayed from our schedule, but nevertheless we're right back, and let's dive straight into our very first topic for today: value-oriented funds. The last couple of months has seen quite an outperformance compared to other equity categories, this after having lagged them in longer time frames. Many value funds, including ICICI Prudential's Value Discovery Fund, has seen quite an uptick, and that's the reason why we decided to bring on board the fund manager of the ICICI Prudential Value Discovery Fund, Mrinal Singh, who's been patiently waiting by as we address the breaking stories of the hour. Mrinal, really appreciate you patiently waiting by and joining us today on this episode of the Money Show. So, like I mentioned, a nice smart rally being witnessed in value funds in the last couple of months, in the last 3 months roughly. This category of funds has really shot to the limelight, really kept pace and beyond with the kind of rally as well that we've seen in the equity markets. However, many of our viewers may not be very familiar with the concept of value funds. So first up, Mrinal, why don't you sort of break that concept down for our viewers, introduce value funds, ICICI Prudential's value fund as well.
Well, thank you for getting me over. What is value and what are value funds? Basically, value investors or value funds are fundamental investors which try to find the gap between the price and the value, that the intrinsic value of the business itself that they ascribe to the entity. Now, the way they work around is what is typically known as margin of safety. So you would typically see, value investors talking about earnings, talking about free cash flows, talking about dividend yields. And very often in practice, there are two traits that would distinctly come across for value investors. One of them is, they are very much counter-cyclical in approach. And the other, and the most important one, is they are very patient. Patience is a prerequisite for very, very important value investing. So what you've noticed just now in the month of March and subsequently, we've seen the market, having a sharp pullback, almost 40% in the month of March, and subsequently almost from there 30% moving up. So typically this kind of zone where the markets have a sharp pullback and then they recover, is the zone of strength for value style of investing. It's a very classical approach. It doesn't generally have much constraints besides the fundamental approach to investing. And we have generally seen that these kind of approaches, these kind of classical style does very well in such zones. So it was the same case if you would have analyzed the data in 2013-14. When we had the taper tantrum, even in 2008-9, when we had the GST, and even going back in history, even in 2016, when we had in January the commodities coming crashing down. So this is how value investors typically try to grab upon attractively priced businesses compared to the intrinsic value of the business itself, and that's how they tend to capitalize on those prices and then wait for the value to unlock. And there are other parameters besides only the valuation, obviously management quality, balance sheet strength, the kind of business they are in, and all those things, to put it simply.
Well, we always say that you need to find a good quality business, get the right valuations, and then invest in it for the long term. So I guess a value fund will be doing the job for the retail investor in that sense, especially for those individuals who really either don't have the inclination to do that work or even the capabilities for that matter. I guess that's where really a value fund does a great job in doing, finding quality business, finding a good value, and then patiently waiting on for that story to play out and really for the value to emerge. So the next question then is, Mrinal, the markets are rallying, as we can see. It looks like we're just a couple of percentage points away now, from that 12,000 mark and the pre-COVID levels, etc. So while the last few months have been very difficult for a lot of individuals, they may be facing income cuts, job losses, etc. A lot of our viewers now, in fact, have been asking us this query that, okay, look, you know what, our situation is a bit better, and we don't mind jumping right back into the equity mutual fund category. Do you believe that, you know, the value fund category would be a great way to sort of ride this rally in the markets, and, you know, now is the time to either dip your feet in, or if not, you know, that increase your SIPs if you already do have funds, you know, or units in value funds?
Well, I agree. A staggered approach to investing is the most optimal approach for retail investors in particular, and particularly in the context of our ICICI Prudential Value Discovery Fund. We have a flagship strategy here on value in India, and we've been running it for more than 15 years. So we've seen cycles with this strategy, or mini and large. And I would say that people who want are very clear about their financial goals, have the virtue of time in their hands. They should choose a larger allocation in a staggered way, be it SIP or STP, in value funds, which have seen the test of time over large and longer periods. So that's very important. And that would be the ideal approach, and it is irrespective of the phase of the market. Although value is a conservative approach, and in equities, we've generally seen that in the long run, value does outperform in a very meaningful way. In fact, the best return records generally globally are with the value style of investing. And that's a very good testament of why it should be there in value funds.
But, you know, like you mentioned, do you believe that value funds could also underperform for prolonged periods of time, and hence individuals should ensure they have the stomach to be able to digest that as well? Like you mentioned, patience, right? That's a key, you know, feature to have to be a value investor.
So that's exactly an important point. It's a very good point. Every style has its strengths and weaknesses, be it value, be it growth, be it momentum, or be it dark. So value also has a zone of weakness, and value also has strengths. Although patience is required, patience is adequately rewarded in value if you are a really long-term investor, and there is data to prove that, at least globally now, even in India. Well, the point is, although value investing does require patience, it does require the stomach to see prolonged periods of underperformance, but then it gets made up very, very fast when the markets turn either way, either up or down. So I would say, particularly for longer horizon investors, and with patience in their hands and mindset, I think value would be a great thing. And they would see that although there is patience demanded, the returns are more than consummate of that patience.
Okay. Understood. Mrinal, you know, since we are talking about this, and like you mentioned, you know, there may be periods of underperformance, then again, it would sort of revert back to, you know, good levels. Risk factor is something else that I would like to talk about. Now, yes, we know equity mutual funds as a category, you know, for a regular retail investor, could be considered as one of the more riskier categories. But within that as well, you have large caps, you have multi caps, you have value, you know, funds. So how would you pitch the, you know, the risk factor associated with a value fund with maybe a large cap fund, or even a mid and a small cap fund for that matter?
Well, most value funds globally are multi-cap or 50-cap in nature, and based on how the market presents itself, could typically be largely allocated towards either large or mid and small. And we've seen that even in our case in various phases of the market. But then the risk, and there are various parameters of risk that people use. Some people use sigma, some people use R square, some people use other measures of risk and things like those. But then generally by the approach that value investing takes, wherein, you know, you have a higher margin of safety and things like those, more often than not, no matter which parameter you use, value strategy comes across on the risk parameters lower than the broader market. So that's the beauty of value style. It generally takes lesser risk because it is kind of patiently waiting for the right prices. And then whichever parameter you want to evaluate upon, you'll realize that with lower beta, with lower risk, the kind of returns that value generates over a cycle, over long periods is quite a feat in terms of statistics also.
Right. Mrinal, let's talk about then, how do you select stocks? The reason why I asked this question is, the last 2 odd years, we've seen even the AAA rated companies default. And yes, while it had larger implications on the debt side of the market, even equity MFs did see a fall in NAV. Quite a few of the names, I mean, you couldn't even imagine that they would, sort of stutter the way they did. So I would like to understand, Mrinal, that when you select funds, and like you mentioned, you do have certain parameters that you look at, and then you decide if this is a good story to be included in the value fund. What are the other parameters you ensure a stock or a company checks the boxes of before you let it enter the ICICI Prudential Value Discovery Fund?
So again, a very important point, although it could be an hour-long discussion, but I'll keep it brief on 2 points. So the most important thing, because I mentioned patience. Patience is a very important criteria that you need to bring on table, both as a fund manager as well as the investor. So the enemy number one for patience is leverage or debt. So because what happens is, typically a business could be available for an attractive price, but then there could be good reasons for it, because maybe in the near term they are getting into a CapEx mode, or maybe they are restructuring or having an issue with some kind of business. But then typical value investors will evaluate and see, okay, this business has the capability to come out of it and will be able to see through it, the balance sheet supports it. But then all those assumptions, all those judgments, all those parameters can fall apart if there is excessive leverage or excessive debt on the balance sheet, because your patience could be worth in terms of what you are expecting and bringing on the table for the consumer debt returns that you see in terms of price value gap. But then leverage will not be patient. There is debt that needs to be serviced every year, maybe every quarter, every 6 months. So well, that can eat up into a lot of profits that typically could accrue to shareholders. We must remember, in a profit and loss statement, the first right of profit belongs to the lender, and then comes the government, and then comes the shareholders. So lender will have their share of profit no matter what happens. So after the EBITDA, the lenders will come, then comes the government, then comes the shareholders. So the government cannot be eliminated; it is going to tax. So that is there. That is the law. So there is no question to skirt it. But then the first part, the lender, the leverage, if there is excessive leverage, we could potentially have, the investment which is playing out in a negative way. So leverage is number one thing that, most value investors are wary about. And, as soon as you mention, AAA, AA, all these parameters come secondary. First, we have to see what is the leverage on the business, because it could be anti-patience when you step into as equity holders or shareholders into company. Then comes the management assessment. It's extremely important. For example, making a soap is far more easier compared to, let's say, making a car. Car is far more complex. But then the way FMCG companies are managed compared to, let's say, auto companies in terms of return ratios, in terms of branding, in terms of sustainability, manpower and all, it is a function of that parameters, those parameters that market rewards them far better. They are more remunerative to shareholders. So it is the management which makes a huge difference. So the assessment of the leverage, even the leverage going ahead, not at that juncture, and the management are two most important criteria that are involved in getting for a value investor to step in. Because the most important thing most value investors are wary about is a value trap. Because it's not that only value investors can do calculations. There are the stocks which trade cheap, but market is a set of very smart people. So the market will not just keep throwing stocks cheap to you. That is not going to happen. So there are reasons. Sometimes there is a desperate seller. Sometimes there is a temporary situation. Sometimes there is a permanent situation. So the idea is to pick a well-managed business with low leverage at reasonable valuation and potential ability to turn around or recover or grow ahead. So that is the trait that typically value investors will look for. The two parameters that I mentioned are without doubt the most important parameters in terms of it.
debt and quality of management. Leverage basically means the debt on the books of a company and the management, the astuteness, the capabilities, quality of the management on of the company. Those are the two factors that Mrinal does watch out for very, very carefully before he decides to let a company or a stock be bought into the ICICI Prudential Value Discovery Fund. All right, Mrinal, just to talk a bit more about the fund, value funds are such that basically invest across the spectrum. It's not, like a large cap fund that'll invest only in large caps or only in Nifty companies or only in mid caps. It basically invests where it finds value. So how is it split across different market capitalizations for the Value Discovery Fund? And I'm just going to club two questions into one. We've seen a nice uptick come by in the returns for the Value Discovery Fund as well. I think almost a 22% rise in the last 3 months, more than that probably. What are the prospects then over there? Because whether it's right or whether it's wrong, a lot of our viewers do have this tendency to look at past returns and then accordingly judge a fund. So just your thoughts and comments on that.
Well, to take the second question first, I would say that, from a longer term approach, value is amongst the most remunerative style of investing, and value discovery has been around long enough for people to analyze in every phase. And I would say that, this is a good thing that there is a lot of analysis, and there's nothing wrong with past analysis. What is important is that you should analyze it in a way that encompasses every phase of the market. Phase typically a downturn, an uptake, a flat phase. So these are typical phases that the market presents. And then in case of our fund, we've been around long enough for you to be able to evaluate it over various phases and see. And you will realize that, we've done pretty well across phases. And there are phases where we don't do well, and there is quite a bit of predictability when the markets are running ahead of data. That is the phase that the value doesn't do well. In terms of the market cap split, that's very interesting. So we've seen that for ourselves. So there has been a time, let's say end of 13, where we were 75% plus into mid and small cap combined, because the market presented itself in a way very attractively in that zone. And then it worked out for us in subsequent 2-3 years. And then for the last 2 years, we've been placed more towards large cap. But then large cap is almost 70% odd for us now, and the remaining is a combination of mid and small cap. But then we don't target a mid and small cap or a large cap kind of allocation. That's not the approach that we take. We typically have a bottom-up approach. We evaluate every stock for its own merit. We select every stock. We see what kind of risk it is going to onboard, and we place it in the portfolio and see if there is a negative correlation available for us. But as we see things now, although we are large cap heavy at this juncture, but then can things change subsequently? The answer is yes. But subsequently, if the market does present itself in terms of better growth prospects or better value prospects, we might actually choose to build on something which could be part of any market cap, be it small, be it large, be it mid. It's just that, when we go down the market cap, our return expectations go higher. And then we've typically seen in our history that our successful investment takes or stock picking in mid and small cap have been bedrock for our fund and have generated superb multi-bagger returns. And we are always on a scout for those excellent businesses which are yet to be discovered by the market. And we have had a history of, being amongst the first institutional holders in a lot of companies which have subsequently become large and well recognized in their own sphere of work in use.
Well, that's great to hear, Mrinal. And, we're already seeing a reversal of sorts come by in value funds. I guess it's key to have patience, to have a long-term investment horizon when you do decide to invest in the ICICI Prudential Value Discovery Fund, and even a staggered approach. So the simplest way, to do so is, of course, with an SIP. Mr. Mrinal Singh, thank you so much for joining us today on The Money Show and, explaining firstly the concept of value funds and, talking to our viewers. I'm sure your unit holders as well are watching you right now on The Money Show about the ICICI Prudential Value Discovery Fund. Well, folks, you can find this entire conversation on ET Now's YouTube page as well, so don't forget to subscribe to that. For now, we will take a very short break, but when we return, we'll be talking about that massive rally in gold prices, which definitely does come in as a neat piece of good news, especially since gold and silver is present in every Indian household. So stay tuned to ET Now. This is The Money Show.